Hello, my name is Quinn, and thank you for joining today's webinar in association with Impact Specialist Finance. And today I'd like to talk to you about the specialist market, where it's been, where we believe it's going, and then I'll tell you a little bit about Pepper Money and how to get those interesting cases through by using Impact services. Interesting cases. It's time to thrive. So let's take a look at the specialist lending market to begin with. It's great to see that over the last few years there's been a 33% growth in the market. Up until last year, £24 billion was written in specialist lending, which is about 10% of the UK mortgage market. And where is mortgage business being placed? Well, it's actually fallen through direct channels over the last 4 years. It's dropped by 3%. Which is fantastic for you and I because the intermediary market has increased by 3%. So we're now seeing 78% of business being written is submitted through mortgage intermediaries. And why is specialist lending growing? Many reasons. Self-employed. 15% of people in work are now self-employed. We know it comes with its complexities. And it's great to see there's so many specialist lenders out there who can give different options and able to help self-employed customers. In terms of our completions, we've seen a 36% increase where applicants have multiple sources of income. And we also know in the market equity release is increasing 25% year on year. First time buyers, we've seen an increase of 5.8% to July this year. It's a real active market for the first-time buyer market, really buoyant. I believe there's two key reasons why we're seeing first-time buyers grow. Firstly, when we take a look at all the schemes that are available, such as Help to Buy, Right to Buy, Shared Ownership, and when we think about taxation changes for landlords, some are opting to offload properties which are being taken up by first-time buyers. So rest assured, it is a very much active market. Now here's the one that gets me. Sadly, we've seen another rise in UK total household debt, and this year it's at 2%. Why is it happening? Let's take a look. CCJs. The number of CCJs being registered each year is on the increase. Up until half one in 2019, we saw 586,000 being registered, so we should finish this year again on about 1.1 million. This is individual CCJs being registered in England and Wales, huge numbers. And when we think it stays on the credit file for 6 years, there are in excess of 5 million CCJs that have been registered. All of these applicants are potentially going to struggle to get a high street mortgage. By using the services of Impact Specialist Finance, we know that we'll be able to help more and more applicants in this type of market. Now the average value of those CCJs is £1,400, so it's actually reduced since 2008 when we had the credit crunch. The average value back then, £3,500. So the trend is quite clear to us that the number of CCJs is increasing, but the value is decreasing. And that's because we're starting to see companies apply for CCJs for less significant events. Things like parking tickets, council tax, TV licence, mobile phone contracts. If you've got a customer who's had a £60 parking fine and they've not paid it in 60 days, it could turn into a CCJ. Does the customer know? Do they know what will happen to their credit file? So it's really, really important that we educate our customers on how to manage their finances better. But of course, the rise in CCJs is just one piece of the puzzle. Sadly, there are so many ways where people trip up, and let's explore that in a bit more detail. Credit card debt now stands at £2,600 per household. In September this year, £11 billion was spent on credit cards. Can you imagine what it's going to be in November and December with Christmas? Huge amounts of money being spent. Utility bills, over £4 per day per household. And a lot of people trip up on 0% big ticket finance. Classic example, customer goes to the sofa shop, they see a £2,000 sofa that they can get on 0% for 2 years, they take the deal, 2 years comes around and all of a sudden they have to start paying £100 a month to that commitment. Sadly, not everyone can afford it and the customer trips up. So people are getting carried away with their spending. We've got to educate. £6.5 billion outstanding on overdrafts. And the worst of them all, payday loans. The average only being £250, but the customer will pay back 1.65 times that amount. Of course, I understand desperate times call for desperate measures, but we have to do everything we can to educate customers to stay away from payday loans. Not only is it extremely expensive, but it will ruin the credit file. And what do we owe as a nation? We owe £1,600 billion in debt, or 1.6 trillion, and that's expected to rise to 2.4 trillion over the next 5 years. So a little bit of doom and gloom there, but I really thought it was useful to understand where we're at in the market. How we can help people is very much education and awareness, and that's down to us as professionals. Now in Pepper we believe this is the new normal. What was rare on a mortgage application is now run-of-the-mill. Circumstances that were once unconventional have become the new normal, and they're the interesting cases that are making up your workload. We know factually interesting cases are on the rise. Let's take a look. A broker in the southeast said to us, "A young couple have come to me for a mortgage. One of them missed a £3.42 credit card payment 8 months ago, and suddenly they're a specialist case. They're not normal." It's becoming more and more common now that clients don't tick regular boxes, says a broker in London. And another broker in London, "My general view is that specialist business is going to progress to become more mainstream over the months and the years to come." And I absolutely agree with that quote, and we're starting to see it today. But here's the thing, interesting cases may be easier than you think. Firstly, I wanted to show you how much time is spent by the average broker. So if you're a broker that submits a mainstream case, the average is around 10 hours per case, and that's taking into account your sourcing, your research, compliance, the numerous phone calls no doubt you'll be making to underwriters, surveyors, solicitors. If you're a broker that writes a specialist case, around 13 hours being the average. But where can time be taken off? By using impact services. Let someone else take that case off you, someone who's got the expertise, the knowledge and a fantastic slick relationship with us as a lender who can really help with those cases. Now at Pepper we are committed to making those interesting cases easier. So we've developed a fantastic application system. Impact use it every single day, so they know how to operate it. The products we offer are clear, transparent, the naming is simple. We're always reviewing and improving our criteria, and we'll continue to do so into next year. And the most important for me is that the cases are reviewed on day one by an underwriter with a mandate. Now with Impact, we actually have a dedicated underwriter who works closely with the team in Impact. Great for consistency, and great to get those cases through even quicker. And here's where it can generate a greater return. Now when you charge a fee for a mainstream case, what we know is that 47% of brokers charge around £500, being the average. Breaks down to £44 per hour. And those charging a fee on a specialist case, what we know is that a higher proportion of brokers will charge a higher fee. So 35% are charging up to £1,000. And that equates to £58 per hour. So the earnings potential is approximately £14 more per hour. Takes around 13 hours to place the case, so you're looking up to £180 before you get to any enhanced prop fee. So here are 3 great reasons to seek out those interesting cases. Well, firstly, we know that they're on the rise. Secondly, it can be easier than you think. Thirdly, it can generate a greater return. But if you're still not convinced, let's help people succeed. Let's think about the end customer and getting them onto the property ladder or reshaping their finances. Pepper was created because of a need. A lot of people being held back by the existing system. Where mainstream mortgages stop, we start. So let's take a look at our interesting cases. Up to October this year, 23% of our completions had 1 or more CCJs. 37% of our business was self-employed. 15% first-time buyers. And 57% had some sort of adverse credit, whether that be as basic as a credit score fail or as severe as a debt management plan. So therefore, 3/4 of the business we do is helping those applicants for other needs, and that could be self-employed, interest only, buy-to-let, complex income, the list goes on. So how does this work in real practice? Well, I'd like to share a few case studies with you now. So firstly, we have an application to raise capital for debt consolidation by 2 applicants. Nikki and Jacob had a life event within the last 2 years. It resulted in 2 CCJs totaling £25,000, and they were registered 13 months ago. They require 80% loan to value. So with this type of case, it will be tiered based on when the CCJ was registered. And because it was 13 months ago, it will fit on our Pepper 12 product range, which simply means no CCJs or defaults registered in the last 12 months. Now with Impact, we do also offer an extra 5% loan to value on the Pepper 12 product and the Pepper 6. So if there are applicants you do have who fit into this category, please speak to Impact, who will be able to find a home for that case. Our second case study is for an application to remortgage an existing main residence by 2 applicants. Robin is a day rate contractor, Christine is aged 59 and unemployed. They require 60% loan to value over 15 years, and they're looking for interest only by way of selling the mortgaged property. So there's an example here where we don't have any adverse credit, but based on Pepper's day rate contractor policy, times 5 times 46 weeks, and the fact that they want interest only sale of property, which we accept up to 60%, we've been able to help the applicants. The next case study is an application to purchase. Isaac is self-employed, trading for 1 year. Oliver is employed on a basic salary with high monthly commission and also had a payday loan that was paid off a year ago. They're first-time buyers and they failed the high street credit score, something we see day in, day out. And they're looking for 85% loan to value. So again, on this example, we're able to offer 1 year self-employed. At Pepper we accept 100% of monthly commission as long as it's paid regularly, and we don't credit score. So the typical case where it fails the high street credit score, a lender like Pepper will be able to offer something alternative. And our final case study is an application for a buy-to-let remortgage. We have Maria and Luke, aged 72 and 70 respectively. They have total income of £18,000. They have 8 properties in the background, looking for 80% loan to value over 12 years. This deal has been placed with Pepper based on our pay rate. We stress at 140% irrespective of tax band, and we have some fantastic pay rate products as well. Also, we don't stress background properties as long as they're washing their own face. So if you've got an interesting case, we are very much interested. As mentioned previously, the products are really simple to understand, Pepper 48 down to Pepper 6, and we also have a separate debt management plan product. And our mission for 2019 has been Mission Possible. We want to make it possible to help your applicants either get onto the property ladder or reshape their finances. Defaults and CCJs shouldn't be getting in the way. Our range of PEPR 6 to 24 is as follows: 5-year fixed rates, 0 completion fee options, flexible criteria for multiple CCJs, there isn't a pound value limit and they don't have to be satisfied, and we will accept as recent as 6 months ago. In these interesting times, thrive with Impact Specialist Finance and PEPR Money. Thank you very much for listening today.